side.
Dirty souls, wolves are hauling. Can you hear the voices calling? Do you feel how they are dragging, waiting for a second to push you to your limits, going strong and feeling better? But do you feel them? Can you hear them say?
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the NASDAQ Daily Update for August the 21st. Thank you for joining us today. We have a lot of good information to cover. We're going to give you a quick trip around the world to let you know what was going on in the world markets. Then we'll update you on two specific stocks of the NASDAQ. That's what we do every day is we cover the worldwide markets and then talk to you just a little bit about some of the valuation, the ESG, and the projections on some of the different stocks in the NASDAQ. So let's get started quickly today. And remember, if you are listening to us on a replay, you can enter questions in. If you're listening to us live, put your questions in. We're glad to talk to you and answer your questions. So let's get started and see what happened in the markets today with a look at the map. We could see that the United States was up, Europe was down, and Asia was up. Now let's look specifically at what happened around the world. But first, let's look at it from this standpoint. One of the big things that's been happening in the news lately is one stock has been growing so much. Do you remember watching Willy Wonka and the Chocolate Factory? And you saw the blueberry girl, and she grew and she grew and she grew. What happened to the blueberry girl? She had to go to the juicing room to get juiced. One has to ask themselves, somebody has to ask, you should ask yourself, is it time for Apple to be juiced? My goodness, they were up 5.45% today. Absolutely astounding. There's no reason for it going up so much. It's just going. If you've got it, congratulations. If you're thinking about getting it, I'd think twice. If we look at what's going on around the world, we see that the markets were up in the United States. They were up. We're hitting records left and right. The NASDAQ itself, although the Dow Jones Industrials led everything up today, the NASDAQ itself has been up 2.7% for the week. And I keep telling you folks this, the market is ignoring what's going on in politics. The market just is reacting in anticipation of what it thinks is going to happen. And frankly, I think that the market's telling us that there's not going to be any change in Washington. So just take that for what it's worth. You could agree to disagree if you'd like to, or you can agree to agree. So let's keep going on to see what's been going on. You see, the market was up today in general, but not every stock was up. We have to look at it from the standpoint of growth versus value. Growth stocks in themselves are those that are growing on the anticipation of what they bring. And there's more volatility to some of those growth stocks. Recently, the value stocks have not been growing quite as much, but value stocks are the type of stocks that are, they exist based on the book value of the company in itself. That's the best way that I put it. If you look it up on Investopedia, you might get a little different answer, but the idea is that we're looking at, if the company looked at actually what its value was, how does it compare to what's on their books? That's what a value company does. Most of those have been down for quite some time. Value stocks were down again today, and we're going to look at two different stocks today that are really going to show you the difference in between what a growth stock is and a value stock. So let's get looking at that. First off, let's take a look actually what happened in Europe. kind of continue on, the coronavirus is continuing to weigh on Europe, and there are some resurgences that are going on too. The Asian markets are doing the opposite from that standpoint. The Asian markets are rising because they're looking in anticipation of what might be happening with the influence of a vaccine. So we saw the Hang Seng Index up 1.3%. We saw the Shanghai Index up about 0.5%. The Bombay Sensex Index in Mumbai was up 0.5%, actually 0.56%. So everything was up in Asia. The Canadian indexes were weighed down with closures based on the COVID-19 virus. So we're seeing it affect different countries differently depending on what stage they are at the advancement of the drug. But you know that going in between Canada and the United States is still limited. You can't come across the border unless you've got some good reason from that standpoint, like you're a truck driver or something. I was in a conference earlier this week, and the gentleman that was running the conference was in Canada. And he said, I couldn't even come and be with you guys in person if I wanted to. So they're still being weighed down, especially small businesses, and small caps were weighed down today. The Toronto Small Cap Exchange was down 1.52%. The Venture Exchange was down 1.24%. Now, the two stocks that we're going to talk about today are BioMarin Pharmaceutical and Cadence Design. And you're going to see that there's a big difference between these two stocks. So let's get right to it. When we throw up the spaghetti graph of what happened today in the market, you can kind of get an idea of what's going on with the NASDAQ. The green line is the NASDAQ 100. That's the 100 largest stocks that exist in the NASDAQ. Remember, the NASDAQ is about 3,500 stocks that's all traded electronically. There's no person that's doing exchanges like on the New York Stock Exchange. All of that is happening electronically. And that stock index is being driven higher and higher based on companies like Tesla, Amazon, Apple, of course, that was up 5.45%. You can see that it plodded along pretty well today, whereas that there are some of the individual stocks that we're seeing like BioMarin and like Cadence Design that are moving around quite a bit. BioMarin was quite volatile, and you're going to see why they were volatile when we talk about what's going on with that stock as we go through everything today. And you're going to see something here that you don't see very often. You're going to see one stock that dropped 35% in one day. Why did that happen? Well, let's talk about that just a little bit, because it happened to BioMarin. This is a look at BioMarin and Cadence Design and the NASDAQ 100 in the past 6 months. If you follow the dancing cursor, like you do every day, you can see that the stock market was down between February and March, and we've made an amazing comeback all the way to where we are today. Did you know that we have crossed over already from being in a bull market that we're now, in a bear market, that we're back into a bull market again? I found that pretty interesting. Now, if we keep going, we can see what has been happening in one day with these stocks. And we're going to keep going here. Okay. BioMarin, if you're not familiar with this company, it's a unique company that tugs at the heartstrings because they are a rare disease drug maker. And what they treat primarily is diseases of children. Now, their very first drug that came out, it treated a disease that is, I'm going to abbreviate it rather than trying to butcher the name. It's called MPS. It's a genetic disease that starts in childhood. There are only really 3,000 people throughout the world that have this disease. Here's the real interesting thing. The disease has a drug that BioMarin developed. It was the first drug that they developed. And the aldurazyme, have to think about that just for a minute. Aldurazyme treated the disease MPS, and get this, it cost about $200,000 for treatment. extremely expensive. Now, I was kind of interested in this drug. So just, for information standpoint, and I use GoodRx, as you've probably seen the commercials out there. So you put your drug into GoodRx, and I put Aldurozyme in GoodRx, and it came up and said that I could get 20 vials for about $19,000. Now, I'm assuming that you have to keep that treatment going on, so that's quite an expensive drug. And you're going to find that all the drugs that BioMarin make are expensive drugs. Now, why did they drop 35% in one day? The reason that BioMarin dropped 35% in one day, and some people might say that this is a buying opportunity, but we're not here to tell you to buy or sell. We're here to point out the news. It dropped 35% in one day because the FDA rejected a gene therapy drug for hemophilia A. And when they rejected that, what happened? We saw a drop of 35% in one day. Now, to kind of counter that, what BioMarin did is that they have another drug for dwarfism in children that was in the pipeline, and they filed the application for that particular drug on the same day. It really didn't have any effect on it, but in the long run, if this drug does work, it will impact the value of the company on the long-term basis. So I think this was done more for shareholders in itself. If you were a shareholder and you saw a 35% drop in your value in one day, I think that you would probably be curious about what's the future of this company, what's the future of this stock. So I think it was a good idea for them to drop that particular drug application on that day. But when we look at it, it was ugly. This is just the last 5 days. And this was Wednesday of this week when it dropped. Gosh, you don't see that much, but it happened, and it continued to go down throughout the week, and it's kind of stabilized. But 35% in one day, what much more damage can you do? Well, you could do 100%, or if you were trading futures or options, it could have something to do in there. But 118.54 down to 76.72 in one day. That's a big drop. BioMarin, as I mentioned, is a company, though, that does tug at the heartstrings because they primarily produce drugs that are for genetic problems, genetic diseases that exist in children. So we see a lot of interest in these particular drugs. Now, what's the possible profitability of this company? When we get to this part, if you've watched these videos before, I talk about the moat of a company. What's the moat of a company? This is what it is. The moat of a company is how wide the profitability margins can possibly be. And we look at BioMarin, we look at the positives and the negatives to come up with the projection of what the moat projection would be. Now, this is information that I gather from Morningstar. So I'm just basically repeating part of the information for you, the listeners. If you want to get this information, you can go to Morningstar and get the same thing that I'm reporting to you. But the idea is, one of the benefits that BioMarin has going for it is that it has a niche that there's not a lot of companies out there that do. It researches diseases that are rare diseases. And the drugs that they create, they are difficult to duplicate. So that's one of the benefits of the company in itself. When they come up with a disease like for MPS that they came up with, that drug is very difficult to duplicate. Now, when a drug comes up you might call it a generic if you want to. If they come up with a generic for that, it still has to go through FDA approval. So the FDA, in some certain instances, has rejected other companies' applications for duplications of drugs. And just the way that the manufacturing is, there are other companies that are out there just leave this to companies like BioMarin and say, okay, this is their niche, and we're not going to tread on that. That's a benefit to them. If you look at the red that's on the screen, you're going to see that two of the downsides of BioMarin is, and this weighs on profits of the company too, and from what we see going forward, research and development is expensive. And the FDA does have high scrutiny. The FDA basically, their value lives and dies by the FDA. The FDA rejects something on one day, and you see what happened. You saw a 35% drop in value in one day. So all in all, BioMarin has a narrow moat. So they do have some competition, but they do have some barriers against that competition in itself. So let's keep going. Okay. If we look, this is just a repeat of what you saw earlier. And this is when we look at a part where we look at the valuation of the stock in itself. And again, this is information garnered from Morningstar. Morningstar rates this as a 4-star company. Now, I have to explain this because I think it's important. There are so many people that think that the star system is based like if you're going to be a 4-star chef with Michelin, you got good food. It doesn't work that way. The idea of the star system with Morningstar is if you are an undervalued stock, you're going to get a lot of stars. And Morningstar sees this stock as being undervalued. When we look at today's close, which was 75.03, Morningstar is projecting their value to be, their fair value to be 105. So they're under the value by about 29% according to Morningstar. So there's a lot of room to go in there from that standpoint. Now, I talk about dividends from time to time, just to let you know, if you are retired and you're looking for a dividend stock, this is not for you. So just move on to look for something else. Look at yesterday's video. I think you'll see more about dividends. All right, let's get into Cadence Design. Cadence Design is another company that is a NASDAQ stock, and they're a specialty company. The company in itself, it is an electronic design automation for chips. They create software that helps other companies create semiconductors, and they're extremely good at what they're doing. But I think this is interesting. If you look at what the Motley Fool said about Cadence Design, is that it's a boring stock. It is a boring stock. There's not a lot that goes on there, but it's only up 900% in the past decade. So in essence, boring is good. Let's take a look at their moat, because their moat also is going to be a narrow moat the way that BioMarin's is, but for different reasons. This is a company that their whole product is a software program, essentially. Now, they do have some proprietary issues, that, some properties that are there. But from a standpoint of a company, most of their profitability comes from their software. If you're an engineer and you're looking for a software design to help you design chips, you're probably well entrenched. You learned about this in college. You've worked with it as an intern. You've continued with it over the years, and you've stuck with whatever that you have gotten accustomed to. But sometimes you may go to other different softwares. There's actually 2 other software companies that exist that do make chip design software, and actually it is Synopsys and Mentor, and those companies have specific attributes in itself. Now, if you look on here, the very third one, Logic Design has an advantage in their design. In other words, the logic of the way that the chips are designed is an advantage for Cadence. When we look at the other companies, Synopsys and Mentor, they have designs and they have advantages in systems design and also in physical design. So each company has a little bit of a niche and advantage. So when one engineer may be thinking of switching from one software to the other, it's not as easy as just going from Edge over to Chrome when you're on your computer. It's a little bit more complicated than that. When we look at the valuation, Morningstar rates Cadence Designs as a 1-star company. Now remember, this is not like you're looking for a Michelin star. The difference is based on the valuation. The reason why that they call it a one-star company is not because it's a bad company. Remember, they're up 900% over the past decade. The reason that they're rated as a one-star is because their close today was 110.57, and Morningstar is saying they're really only worth $53. So they may be overvalued at this point, and it may be a stock that you don't want to get into at this point in time. Oh, you know what another one-star company is? Apple. Yes, it is. Apple is a one-star. Now, this is just this boring stocks return. And if you look up my dancing cursor here, you can see what happened in between February and March. And then we can see where we are today. It's been a march up. And actually, if you look at it in the time period from March till today, it's up 51%. Not bad. Again, this is a company that doesn't have a dividend. So if you're retired, you're looking for dividends, go to another place. Why would you want something like this if you are, let me take just a minute and talk about that for a second, because I think that's significant. Why would you want growth stocks in your portfolio if you are retired? Okay, I'm going to suggest that you go back on my YouTube channel at Richard's Financial Planning. And if you can't find it, go over to richardsfinancialplanning.com all the way down to the bottom, and you'll see the connection to the YouTube channel there. If you go back to my YouTube channel, I can educate you on why that growth stocks can fit into a retiree's their retirement plan. And the reason is we use a strategy called bucketing. Look for the video that describes bucketing. The idea is that you create buckets of money, buckets of assets. They're going to be utilized at different times during your retirement. If you retire and you think that you're going to be retired for 30 years, well, you're going to have to think of what you're going to be using in between year 20 and 30. And that's where growth stocks really can still come into play. You have to be using them within your comfort range of volatility. And there's a whole science to that we help people with using the modern portfolio theory. If you want to learn more about retirement planning, so blanked out there just for a minute, but thank goodness for StreamYard that keeps going. Okay, where are we now? We're getting back into, we're going to talk just a little bit about the insiders of these companies. Insiders can give you some direction on, and maybe an indication on whether a company is overvalued or undervalued. When we look at BioMarin, remember, BioMarin was a 4-star company by Morningstar, and they're saying that this stock is undervalued. Well, Morningstar is not the only entity, only people that are saying that this is undervalued. Actually, the people that work for the company think that it's undervalued too. Take a look at what's on the screen. You're going to see buyers and sellers. So you'll see that in the last 3 months, really, there's been 19 buys and 15 sells. And these are people that actually work for the company. In the last 6 months, it's been 53 and 54. And in the last 12 months, it's 68 and 80. So we see that there's a pretty even distribution of buyers and sellers. It's not like in days past where we put up when we put up buyers and sellers and seen insiders selling like crazy. Now, let's take a look, though. If we go over and we take a look at Cadence Design is a little bit different, because what you're seeing at Cadence Design, remember, this is a 1-star company because it's considered to be overvalued. Now, Morningstar is not the only people that think this is overvalued. People that actually work for the company think that it's overvalued too, because if you look at the last 3 months, you can see that there have been 32 sells and 14 buys just in the last 3 months. These are people that work for the company. So there's a consensus that the stock is overvalued. So keep that in mind when you're looking at buying and selling stocks. Okay, this is actually looking at what the two are side by side, and I think you can see the difference between the two. If you look at BioMarin, you can see that the close was 75.03 compared to the fair market value projected by Morningstar at 105. When we go over and look at Cadence Design, you can see why that there's a difference between a 1-star and a 4-star. You can see that the close on this was 110.57 and the fair market value is 53. That's why this is a 1-star, because it's overvalued. Okay, let's get to the next part. I like this part, and I hope you do too, because we get to talk about the environmental, social, and governance attributes of these companies, and we're also going to hit upon the BRI, or biblically responsible, issues of these companies too. Of the NASDAQ 100, if you follow the dancing cursor, these are the negative ESG attributes. These are the negative attributes. If it's in nuclear power, GMOs, weapons, animal testing, gambling, alcohol, pornography, these are all issues that are not favorable and that not everyone out there wants to be involved in. When we look at it on an individual basis, let's look at BioMarin first. Now, I use MSCI a lot when I'm talking about ESG because I think that MSCI does an excellent job of research into ESG. We're going to talk about another company when we talk about BRI in just a moment, but they rate BioMarin at the middle of the pack. They're rated as a triple B company when it comes to ESG. If we look at the individual issues, they're saying that they're laggards in human capital development. However, they're leaders in corporate governance and access to healthcare. I think that one of the reasons why that they're probably considered leaders in access to healthcare is because, remember, they develop drugs that are primarily for children, and they have a heart for their patients, their children that they're trying to help. And there are programs that are available for families that can't afford these drugs because they are quite expensive. Remember, the one that we talked about to treat NPS was $200,000. So not everyone can afford these types of drugs. So they are a leader in access to healthcare. When we talk about the biblically responsible aspects, I started putting this up here because some people were emailing me and saying, what do you mean by BRI? When I'm talking about BRI, there's a company that I refer to that's called Inspire. And Inspire researches the biblically responsible aspects of companies, just like MSCI investigates the ESG, the environmental, social, and governance. But they look at it from, Inspire that is, looks at it from 4 standpoints. They look at the customers, they look at the community involvement, they look at the workforce, how they're involved with their workforce, and they look at how they're involved as a citizen of the world. So you're going to find that a lot of the attributes for BRI, or biblically responsible investing, are similar to ESG, or environmental, social, and governance. So let's look at what the individual attributes were for Biogen. And you'll find that it's actually negative. Inspire's rating is a -12. They rate in between +100 and -100. You could say that -12 is pretty close to the middle. There's some certain things out there that exist, and if you want to know more about it, email me and I'll give you more information about it. But just to give you an example, animal testing is one of the drawbacks from a biblical standpoint for Biogen. It's not the only one, but it's one. Animal testing is one that every pharmaceutical company out there utilizes. To the degree that they do it humanely is a different question, and that may be something that influences whether that you would want to own this stock or not. Now, if you want to own ESG, let's talk about that just for a quick moment. If you want to own just good ESG companies, or you want to own just good BRI companies, then what I'd suggest is use a technique that's called direct indexing. Now, direct indexing goes beyond buying a mutual fund. It goes beyond buying an exchange traded fund. Because when you utilize an exchange traded fund or you use a mutual fund, and if you say you could go to a company like MSCI, and MSCI is going to say, this company is great in the average. We give this mutual fund or this exchange traded fund a triple B. Well, it might not fit your criteria. You might say, I don't want to have companies that do animal testing. So how do I get rid of that? Well, through direct indexing. And direct indexing, what it is, you own individually every stock in that index. And if you use a company, like I use a company called Folio. So Folio allows clients to have fractional shares. So you don't have to have an individual share. And that makes a big difference, because if you've only got $100,000 or $10,000 to invest or something like that, then having fractional shares is important. Because say, for example, if you wanted to buy a share of Tesla, well, if you can't buy 100 shares because you don't have $200,000, you might want to buy one share. It depends on how it works, but I want to get off that track too far. Direct indexing can pull out negative attributes. In other words, we can go in and we can put all the stocks of the NASDAQ 100, and you could own every last one of them except pharmaceuticals, if you were vegan and you were concerned about that. Or if you're a Christian and you're concerned about the BRI aspects, then we can go and we can pull out the companies that are negative from that aspect. That's the beauty of direct indexing. Okay. If you want to learn more about that, go over to my website at richardsfinancialplanning.com. I've got a blog that I wrote about it, and there's also a video. If you go over to the YouTube videos, you can learn more about it from that standpoint. But let's get back to what we were talking about with the individual stocks themselves. Okay. Cadence Design, we're coming up to the end of this in just a little bit. Remember, if you've got some questions, just enter them in, and I'm glad to take a few moments and talk to you about what your questions are. But let's just keep going on down the road here. Cadence Design, MSCI actually rates them better than BioMarin. They rate them as a AA company. Now let's look at some of the individual issues. They say that there's really not anything that they're lagging behind as far as ESG goes. They're average when it comes to corporate governance and carbon emissions, and they are excellent when it comes to human capital development, privacy, and clean technology. So Cadence Design has a lot going for it. Now, when we look at the BRI ratings that we get from Inspire, they're actually very good too. This is one of the highest ones that I've seen. It's a 67. Remember, it goes in between negative 100 and positive 100. But what we're seeing here is we're seeing a positive 67, which means that there are a lot of Christian attributes and principles being utilized to run this company. So it has a high BRI rating. Okay. And that brings us to the very end today. I want to remind you that what we do at Richards Financial Planning is we design financial plans that help people avoid running out of money during retirement. And if that's something that you want to learn more about, go over to the website at richardsfinancialplanning.com, and you can actually sign up for time to talk to me. If you look for the teal colored button down here, you can just enter in, schedule a call to learn more, and you can get to my calendar. You'll get a 15 to 20 minute conversation. We'll talk about your questions. If you want to talk about ESG, if you want to talk about BRI, where it's like, how does bucketing work? What's the best withdrawal strategy? I can help you to do that. We can talk about it, and we can talk about the program that I have, which is called the Secure Future Plan. And you can learn more about that on my webpage. If you are interested in all this stuff, I encourage you also to stick around just for a moment and watch the disclosure at the very end. And if you're still hanging on and you just tuned in, go back and watch the replay. All the information's there. You can just forward through all the boring stuff if you don't want to watch it. But that's all we have for today. And I want to thank you for listening. And we'll talk to you on Monday. Have a great weekend.